Assalamualaikum and hi everyone, we are from Group 1. We will present to you about Fintech in Islamic finance literature.
Islamic ethics and economics are interwoven notions that Muslims use to guide them in both personal and financial transactions. Adherence to the 5 pillars of Islam, including prayer, zakat, fasting, pilgrimage, and proclamation of faith, are its key principles in terms of economic ethics. In addition, zakat aids in wealth redistribution. Islamic banking avoids interest-based transactions, and sukuk invest in real estate, aligning economic activity with ethical belief. Islamic fintechs refer to the use of technology to enable incremental or drastic improvement in financial services. The Financial Stability Board defined fintech as technologically enabled financial innovation that could result in new business models, application, processes, or products with an associated material effect on financial markets and institutions and the provision of financial services. Next, Islamic fintech is essentially the combination of Islamic moral and ethical principles with cutting-edge technological innovation. This integration creates a disruptive force in the financial sectors that not only offer efficient and transparent financial solutions but also coordinate them with a set of principles that promote moral and ethical behavior.
The Islamic fintech has been designed within the principle of Islamic finance. That's the key idea behind Islamic fintech. So, why should we care about this? Well, studies show that 3 main factors influence our choice to use Islamic fintech. The number 1 is Sharia compliance. It's all about ensuring everything, from payments to investment, follow Islamic principle. No shady businesses or interest-based dealing here. Second, easy to use. Who wants a clunky app? Islamic fintech providers need to focus on user-friendly interfaces and smooth operation. The number 3, customer knowledge. The more we understand how these services work within Sharia guidelines, the more confident we will be to use them. Islamic fintech also has a big impact on financial institutions like banks and microfinance. Fintechs can reduce costs, meaning more competitive products and services for us. Next, both goes. Imagine Islamic finance reaching new market and contributing to economic development. The last one is offer new solution. Think real-time transaction, better access to funds, and even Sharia-compliant money creation. But there are challenges too, which is the number 1 is lack of clear regulations. Means make things confusing between both users and providers. Second, cyber security risk. We need strong data protection to keep our financial information safe. And the last one is ineffective Sharia oversight. We need to ensure these services generally comply with Islamic principle.
Now we move to second stream, which is cryptocurrencies. So, what is cryptocurrencies? Money is regarded as a medium of exchange rather than a commodity in Islamic banking. However, the emergence of digital currency has reignited the discussion about the status of money and its dynamic, particularly in the context of cryptocurrencies. In this context, we closely examined Bitcoin nature and properties and found no contradictions between Bitcoin and Islamic rules. Nonetheless, cryptocurrency are extensively criticized from a functional standpoint for the following primary reasons. First, all items in the cryptocurrency terminology are produced from financial engineering and are not backed by real economic asset. Consequently, it does not fit into Islamic finance. Second, Islamic finance prohibits interest speculation-based interest. Furthermore, recent studies reveal that cryptocurrency are inefficient, high volatilities, and speculative, very vulnerable to macroeconomic factors, and due to their speculative nature, cannot be used as a means of exchange on the ground. Third, cryptocurrencies are utilized for criminal purposes such as money laundering and the purchase of narcotics and weapons. Cryptocurrencies are types of digital currencies that are not typically accepted or issued by a central bank and hence do not have the same characteristic as fiat money. Finally, and most significantly, because of the aforementioned consideration, cryptocurrencies are not directly backed by any country or regulatory body. Unlike conventional money, which has monetary policy repercussions. In this regard, Mr. Abu Bakar 2019 suggested that cryptocurrencies have three competitive advantages over other kinds of money. First, they are built on a unique decentralized financial system. Second, they are regulated instruments. And third, they can be used to overcome inflation. As a result, it can be inferred that Bitcoin has characteristics comparable to other financial instruments, and the enormous volume of information linked to Bitcoin will gradually reduce the Muslim perspective on Bitcoin as a city, which is moral. Furthermore, the legal regulation relating to Bitcoin Sharia compliance should be intended to examine and improve its legality from an Islamic perspective.
Blockchain is an innovative technology supporting cryptocurrencies, has emerged as a transformative force in Islamic finance. It goes beyond being just a decentralized database, fundamentally changing how financial transactions are executed, verified, and documented. This technology holds the potential to enhance the dependability of sukuk transactions, increase transparency, and reduce uncertainty in Islamic financial instruments. Researchers like Chong 2021 highlight its qualitative approach, emphasizing its applicability beyond sukuk. Blockchain can revolutionize various fields, including halal food, profit loss sharing investment, and zakat administration, thanks to its inherent properties of transparency, traceability, and resistance to fraud. In the complex realm of sukuk transaction, blockchain technology can increase trustworthiness. Two challenges arise from the lack of standardized Sharia principles and narrow national laws. Notably, sukuk-related smart contracts and tokenization play a crucial role in reducing operating expenses and ensuring strict adherence to Sharia standards. Beyond its technological identity, blockchain enters the musyarakah financial scheme, driving revolutionary e-negotiation dynamics. Combining blockchain with smart contract promotes transparency and trust in interaction between investor and business owner involved in musyarakah contracts. In zakat management and takaful service, blockchain acts as a catalyst for efficiency in Islamic insurance. It provides powerful in times of crisis, such as the challenges brought about by the COVID-19 outbreak. However, obstacles like a lack of expertise, conflicting fatwas, and the absence of universally recognized Sharia norms hinders its optimism. The narrative emphasized the importance of community involvement and education to spread awareness about blockchain's benefit in Islamic social finance, particularly in the complex dynamic of zakat. In conclusion, blockchain has the power to revolutionize Islamic finance, enhancing accessibility, efficiency, and transparency, overcoming current obstacles, and encouraging cooperation among stakeholders may lead to substantial contributions to a more just and morally responsible global financial landscape, ushering in a new era of sustainable growth through these technologies.
I will present about the third stream, which is financial inclusion. What is financial inclusion? World Bank has defined that financial inclusion is the opportunities to access financial services where it helps people to build wealth, including saving, credit, loans, equity, and insurance. As you can see in my slide, we have an infographic about how financial inclusion works. We have two parts. The first part, unserved, when someone has no basic account and have restricted access to the financial services. They also rely on cash only. We move to the second part, serve. When someone have the transaction account, which is they can get from bank, microfinance institution, and card companies, they can do savings, financing, payments, and insurance. The serve in financial inclusion have the authority of transaction account access, and they have a broad range area of financial services. Now we move to the next topic, which is role of financial technology in financial institution. From my research, I found three roles of financial technology in financial institution. First, they have expanding reach and access, where they empower individuals to navigate Sharia-compliant financial practices, which give opportunity to participate in the economic system. Second, we have developing new Sharia-compliant products and services that prepare greater clarity and accountability within financial institutions, where they also provide the real-time information and updates. The third one, which is the last one, is enhancing transparency and trust, where we encourage partnering of Islamic finance and fintech companies. We have an example of robo-advisors, crowdfunding platform, and P2P lending platform.
We continue with Stream 4, Islamic Fintech and Deposit Lending under substreams peer-to-peer. The initial subteam focused on peer-to-peer lending, which serves as a platform to facilitate borrowers obtaining funds from lenders via the internet. In general, P2P lending platforms are predicted to be a new banking service with several additional advantages such as speed, efficiency, and improved channels over conventional banks. However, instead of considering P2P lending platforms as competitors, integration and cooperation between Islamic P2P lending and Islamic banks are proposed to foster positive trends in the business cycle, particularly those that benefit the small business sector. Building on the prior discussed regarding the Musyarakah contract, Aprita and Aditya stressed the effectiveness of the profit and loss sharing scheme in specific business models. They advocate that implementing this scheme should prioritize transparency among involved parties. Additionally, it recommends collaboration between P2P lending platforms and notaries or legal entities to enhance safety and expedite transactions. Another interesting study by Ali proposed a conceptual framework that predicts the intention to adopt fintech in SMEs peer-to-business (P2B) financing platform. This research emphasized two important factors that shape the use of P2B platforms. First, internal factors are derived from cost, brand, safety, perceived ease of use, and usability. Second, external factors include social influence and facilitating conditions.
The second subtype in this stream is crowdfunding. Crowdfunding is a way of raising money to finance projects and business. It enables fundraisers to collect money for a large number of people via online platform. This contribution can range from small donation to large investment and often come from a diverse group of backers who share an interest in the project. So, crowdfunding based on four main types. First, donation. Second, debts. Third, reward. And lastly, equity based on crowdfunding. Lending-based crowdfunding is treated differently in this case, since it is clear that Islam prohibits interest at all costs. The platform must rely on Islamic financial contracts and process without interest, such as use of the mudarabah and ijarah. Based on the principle of mudarabah, all capital is guaranteed, and in the case of default, all material in the business will be liquidated and returned to the investor. Mudarabah crowdfunding is a collaborative financial arrangement involving three key parties. Firstly, they are the publisher acting as the mudarib. Secondly, the platform serves as the intermediary connection between the publisher and the founder. This platform plays a crucial role in the marketing and promoting publisher to attract more funder. And lastly, the funder, often referred as a Rab al-Mal. Since Islamic crowdfunding is based on mudarabah model, is it a matter of concern whether the profit distribution follow the law of the country? Islamic crowdfunding is strictly allowed from the business permissible in Islam and not allowed to have a conventional lending approach involving interest.
Through a content analysis of each stream, we find that the interaction of fintech in Islamic finance holds great potential for advancing socio-economic development, especially for the unbanked, small and medium-sized firms, and undeveloped communities. Fintech adoption in Islamic finance would also help the government achieve the Sustainable Development Goals (SDG) for a sustainable country, overcome financial crisis, and enhance financial inclusion. However, the main barriers preventing the growth of fintech in Islamic finance include the absence of rules, regulatory restrictions, and a lower level of financial literacy. Furthermore, the study emphasized, in keeping with the findings of earlier research, that there is still uncertainty regarding the Sharia compliance of blockchain technology and cryptocurrencies, with a tendency for this platform to be rejected as means of trade.
That's all from us. Thank you.